Welcome to Life Happens, where Texans come to protect their legacy and prepare for the second half of life. Join your host, Attorney Kim Hegwood of Your Legacy Legal Care, and our weekly guest as we navigate the challenges that emerge as life happens. Now here's your host, Kim Hegwood.
Good morning and welcome to Life Happens with me, Kim Hegwood, and my very special guest today is Rodney McGraw. Good morning.
Good morning, Kim. Glad to be here.
Good, because we're going to talk about something I have no idea what it is, and so we're going to be talking about lifestyle home loan.
Yes.
And so you're probably going to have to start off by telling me, exactly what it is and how it differs, maybe other things.
It's still a very little known strategy that's been around since 2009 that baby boomers have been using to purchase their dream home. It's known in the industry as a HECM for purchase. That's what it's known as.
Okay. So what is a lifestyle home loan?
Okay. Well, the HECM is a home equity conversion mortgage that you use for purchase. It is a FHA insured non-recourse loan that really you can use to buy the house that you really want, if you're a boomer. But if you think about it, do you really want to take out a loan to, make those repairs or upgrades that you want to make, or do you just, or if you have the option, just move and have all new appliances and have a fresh start? Or you think about it that right now you're living in a 2-story house and you'd rather just move and stretch out in a big flat and use your whole home again. Or you want to move closer to your grandchildren or closer to your hometown, or whatever your dream home is. The lifestyle home loan gives you the ability to purchase that dream home for as little as 55 to 60 cents on the dollar.
Okay, now that is a good fact. I'm like, wow, okay, now I'm listening, and then you said that, I'm like, now I'm getting there. Now we're getting somewhere. And
Okay.
so, and how common are these, what you call them, HECM loans? How common are they? Because until I had met you, I had never heard of these.
See, right now, there's really only about a 2% awareness that this even exists. Well, right now in the state of Texas, there's really only 3 ways that you can purchase a home, if you're 62 or better. We'll just use, say, a $300,000 home for an example, for simplicity's sake. So if you could buy it just straight cash, you can pay $300,000 plus your closing costs, and then you own the home. You have all the rights and privileges of a homeowner, so you could sell or refinance at any time. But you also have all the obligations where you have to pay the property taxes, the homeowner's insurance, any HOA fees, and of course, regular maintenance of the home. But it's yours.
Right.
Or second way is what they call a traditional or conventional 30-year mortgage, where you go in and you put a down payment, which is normally about 20%. So if you look at a $300,000 home, you have to come up with $60,000. Then you finance the rest for 30 years. And it just, all in all, if you think about it, over that 30-year term, you end up paying anywhere between 2 to 3 times more than you started out, right?
Mm-hmm.
So
Yep.
I don't know about you. I don't really want to make mortgage payments when I'm 80, but that's beside the point. But you end up paying it. Just say you look on the low side and you only pay 2 times that amount. You spend $600,000 for that same house.
Yeah.
Or the third option, if you're 62 or better here in the great state of Texas, is the lifestyle home loan, where you go in and put down basically 60%. It serves as your down payment in essence, but you never have a monthly mortgage payment at all as long as you live in the home. You still have all the rights and privileges. The title's in your name, so it means you can sell or refinance at any time. You also have the same obligations where you have the property taxes, homeowner's insurance, of course, the HOA fees and regular maintenance of the home. It's a non-recourse loan, which means that, again, as long as you live there, you're not responsible for making any monthly mortgage payments at all. If you want to pay it off early, you can, because there's no prepayment penalty. However, since it's a non-recourse loan, neither you nor the insurer. Think about that.
So I want you to repeat that last thing.
Okay. I said neither you nor your heirs have any personal liability to repay the loan because it's a non-recourse loan. and federally insured.
All right, so let's do some little fact things here, so I'll make sure that me and the listeners are on the same page.
Okay.
I'm 62 or older, and I find my dream home. I basically purchase it for 60% of the asking price, so to speak.
Mm-hmm.
And does Mutual of Omaha kick in the rest?
Well, it works. Mutual of Omaha would be the lender in this example. What we come in and we would finance the remaining property. But again, since there's no recourse, I mean, you're not responsible for making any payments as long as you live in the home.
Mm-hmm.
Once you pass on, then your heirs will have the same rights and responsibilities to repay the loan and keep the home, or just sell the home and keep the difference.
Okay. And so you said that we don't have to make any payments on it, but you
Right.
could make payments on it if you wanted to, correct?
That's right. That is correct.
And does the loan become due at the time that, like if it was me, at the time that I passed, is that when the loan basically becomes due?
That's a great question. Really, a home equity conversion mortgage really works just like a traditional mortgage, except the lender is forced to be patient. See, since you're not required to make any payments as long as you live there. But if you decide that you want to sell the home, of course, then the loan becomes due. Or if you will recall, permanently relocate, which means that if you pass on or you don't live in that home, that's no longer your primary residence for 12 months or longer. Then that would be the case. Just like a loan, then it would just pay off the balance, and and you keep the difference. Now, in the case that the balance of the loan is more than the house is worth, then if your heirs decide that they want to keep the house, they will be responsible for the lesser of 95% of the appraised value of the home or the mortgage balance. So if the loan is worth more than the appraised value of the home, they could pay 95% of the home, keep the home. Let's say, give that same example, $300,000 home. Let's say the value is dropped to $100,000, and for some reason the balance on the loan is $300,000. The heir could pay $95,000, which is 95% of the value of the home, maintain the value of the home, but then you say, well, what about the other $200,000? That's when the FHA kicks in. The insurance pays the difference.
Oh, okay. And so is there a limit on how much money I can have in a house, or how much house I can spend, rather, or
Well,
can I have a $1 million home in this program? I mean, so
that's a great question. Now, the amount of money that you get is based on the age of the youngest borrower, the expected interest rate, and the maximum claim amount, which in essence is the value of the home, which as of January 1st, 2024, the maximum claim amount is $1,149,825. So anything higher than that would not be FHA insured.
okay, but I could have that $1 million home and still qualify.
You certainly could. In essence, when you think about it, if you can purchase $1 million home for $600,000, makes it even more attractive. Wouldn't you agree?
I know, that's what I'm thinking. So it's like the whole time I'm thinking, like, wow, this is a really good program.
Absolutely.
And so, but most people, I truly think that a lot of people don't know anything about it. I don't know anything about it, and I thought I was pretty savvy, but evidently, some hadn't come across my radar. And so, but is there any kind of specific requirements in regards to qualifying? Do I have to be healthy? Do I have to have a good credit score? I mean, you're borrowing money for less than the value of the house. So,
You're absolutely right.
I need to know what's the catch.
Well, that's a question I always love to hear. What's the catch? Well, the thing is, you have to be at least 62 or better here in the great state of Texas. Again, the amount that you're approved for is based primarily on your collateral, which would be the home, your primary residence. Since it is designed for senior 62 and better, the same debt-to-income ratio requirements don't exist. Credit checks aren't the same because basically the collateral is what's important. your home. You want to make sure that your home is secure. That's really what's important. Now, one thing that we do look at is your history on your property taxes, homeowners insurance, and any HOA fees, because those are the things that you're responsible for maintaining even after the home equity conversion mortgage is closed.
So, well, I'm fortunate with my house, the mortgage company pays the taxes, they pay the insurance. I just have to pay those darn HOA, fees at the beginning of the year. And so, all I can think about is, I'm paying some money. I understand that the pool gets taken care of and, in the grass, but I'd like to be able to cut the person that tells me my trash can didn't get put up fast enough.
I know what you mean. Oh, yeah.
I'm thinking, wow, I would not want that job because I'm pretty sure people in my neighborhood all hate her, so
yeah.
But, poor girl, it's just got to be a rough job. And so how do we help you get the word out? So a lot of my clients are 60 and over. So what do we tell clients that we can help you that, hey, I got a guy that can get you in the house for less money, so without feeling like I need to whisper it, kind of thing. So, I'm
the thing is, not too many people know about it, but it is legal, of course.
I know.
It's a great thing.
I'm messing with you. It's okay.
But the thing is, really is just letting everybody know. Because I say right now, there's really still only a 2% awareness across the country that this product even exists. So really just, if you're 62 and older, especially if you're still paying a mortgage payment at all, it's something that you want to take a look at. If you're considering moving, now I'll give you an interesting story. I was working with a guy, and I used to say downsize because a lot of people wanted to downsize after their children left. This guy, this couple rather, they had 4 sons, a huge family. Each boy had his own room growing up, and they had a lot of space in the back. It's a huge home, very nice home. And I just assumed, which I should never do, assumed that they wanted to downgrade or downsize. But he said, oh, no. I said, well, you have your 4 children and they're all leaving home, or they've all left home. He said, yeah, but my oldest 2, they already have children, and my 3rd one has 1 on the way, and my 4th one, I never know what he's going to do. So I want to make sure that I have room for everybody for the holidays so they can all come back home. So I stopped saying downsize. I just say right size from that point on. So it gives you the opportunity to right size. Whatever's comfortable for you, you can do it.
I can appreciate that because I want to go to a 1-story. So I want to take those 4 bedrooms up top and drop them on the other side of the house because like my kids are, for the most part almost out, but the grandkids all have rooms now. They have their room, so I'm like, I can't downsize, then my babies won't have any room.
Exactly right.
And they're really rotten. And so, most definitely. And so let's see, you have to be 62.
Yes.
Property has to be decent. Do you have to have a history of paying property taxes prior? Paying property taxes, insurance?
You don't want to have a bad history of paying property taxes. Okay. And of course, it does have to be your primary residence. Let me add that.
Okay. And so, but I can, basically get the house of my dreams for 60%. And of them funds. Okay. So I'm trying to figure out what the downside is. So I guess from the pessimist lawyer in me, is it one of those things where, is it kind of like having a balloon payment for the kids down the road, of going, oh, now we got to pay for the house if we want to keep it. Can they refinance and keep the house?
Absolutely can. You absolutely can. Again, once the balance becomes due, they have the same rights as the original borrower. You could sell the home and just keep the difference, or just pay off the balance of the loan and keep the home. It's completely up to you. We don't slowly take over ownership or anything like that. It's still completely up to you what you want to do.
Perfect. All right. Well, here's the kicker, Rodney. How does people find you so they can get one of these loans?
Well, I'm very easy to find. You could call me or email me. Telephone is preferable. I'm easy to catch. Doesn't matter what time it is. I don't really have regular office hours. So if you have a question, you can call me or shoot me a text. I'll get back with you.
And that phone number?
It's 346 762-5660.
And your
Or
email address?
you can email me at rodney.mcgraw@mutualmortgage.com.
Perfect. And so, all right, this is still good information. So, and hopefully a lot of our listeners will get that information. And so, most definitely, thanks so much, hon. It's good to see you, and appreciate you being on the show. And I know we'll probably have another opportunity to do it again soon.
All right, Kel, thank you again for having me. I just want to thank you for everything that you do for the community. I appreciate it.
And same here, Rodney. It's good to see you.
Thanks for tuning in to this week's episode of Life Happens with Kim Hegwood. Be sure to tune in every Thursday at 10 a.m. wherever you listen to your podcast as we navigate through the challenges that emerge as life happens. The content of this podcast does not establish an attorney-client relationship or constitute attorney-client privilege, legal, medical, financial, or any other professional advice.